Malaysia's economy is sometimes considered as one of the few successful economies in Southeast Asia. And that's because of their higher GDP per capita as compared to all other Southeast Asian economies. The only country that has a higher per capita than that of Malaysia is both Brunei and Singapore. But beyond these two, Malaysia has always been a leader amongst the region. But there's an indicator right now that showcases where Malaysia actually lags, and that is the holdings of gold reserves. Here's a graph on the gold reserve by country. Data from the World Gold Council. Here you can see that Malaysia's gold reserves amounted to just 38.88 metric tons, which by all means is much lower than most of the major Southeast Asian economies. It is even lower than Cambodia, which has an economy that Malaysia far outshadows. At 38.88 metric tons, the value of Malaysia's gold sits at only $3.2 billion, assuming current gold prices. Just compare this to, say, Thailand, which has gold reserves of over 235 metric tons, which at market value is over $22 billion. So, knowing this, why is Malaysia's gold reserves so low? Does it mean that Malaysia's economy isn't as bright as one might actually think? Well, to understand what the reason is, it is first important to know the importance of gold in one's reserves. Gold reserves are a key component of a country's official reserve assets. Traditionally, gold has been considered a reliable store of value. They are a hedge against inflation. Gold often retains its value even when paper currency loses purchasing power. They are a safe haven from crises. In times of economic or political uncertainty, investors and governments often turn to gold. And thirdly, they are a diversification tool. Holding a mix of assets like US dollars, euros, and gold can help a country manage risks. So, in general, countries around the world hold gold based on economic conditions, geopolitical risks, and the performance of various financial assets. If we were to graph out the countries with the largest gold reserves, we actually get to see just how small Malaysia's reserve is. For instance, here in the graph you can see that several European economies, like Germany to Italy, hold gold reserves amounting to over 3,352 metric tons and 2,452 metric tons, respectively. Comparing that to Malaysia's 38.88 metric tons, the difference is staggering. Even within Asia, countries like China and India have significantly larger gold reserves, with China's gold reserves exceeding 2,000 metric tons. So, shouldn't Malaysia be trying to purchase more gold in order to catch up to global standards? Wouldn't it be wiser for the Central Bank of Malaysia to hold gold to ensure that they avoid, or at least manage, economic uncertainty or geopolitical risks? Well, if we were to graph out Malaysia's purchase of gold, we actually get to see that their gold reserves have been on the rise. Here in the graph, you can see that back in 2013, Malaysia only had gold reserves of 36.39 metric tons. And since then, gold reserves have fluctuated and only ended up to 38.88 metric tons. It increased, but not by a lot. In contrast, if we were to graph out Thailand's gold reserves, for instance, we get to see that their gold reserves have been on the rise. As a matter of fact, some reports even said that Thailand is actually one of the largest gold buyers in the past decade, from 2013 to 2023. Singapore, on the other hand, was only among the largest buyers in the past few years. So, how about Malaysia? Well, one of the primary reasons for the low level of gold reserves in Malaysia is policy choice. What is policy choice? It is a deliberate decision made by a country's government or central bank regarding how it manages its financial resources. Unlike countries that face high geopolitical risk or sanctions, like Russia or China, which forces them to actively accumulate gold, Malaysia's central bank has adopted a more conservative stance on gold accumulation. Bank Negara Malaysia appears to have set a target, or comfort level, that does not require heavy gold holdings. This can be because Malaysia, while exposed to regional uncertainties, has not experienced the kind of political or financial turbulence that compels many emerging markets to increase their gold reserves. Put simply, Malaysia isn't really exposed to these geopolitical problems like China or Russia has with the United States. For instance, if we were to take Russia, which has been one of the world's largest buyers of gold as of the last decade, its aggressive gold accumulation strategy was largely driven by geopolitical pressures. After facing economic sanctions from the West, Russia sought to reduce its dependence on the US dollar and other foreign currencies. By increasing its gold reserves, Russia was able to strengthen its financial independence and reduce the risk of its assets being frozen by foreign governments. Malaysia doesn't really face this kind of issue. It has good relations with both the East, as we pertain to China, and the West, mainly Europe and the United States. You can easily see this through various international dialogues and continued investments. Malaysia is one of the only few countries where it sees a big inflow of foreign investments from both China and the United States. It is why we see big semiconductor investments being poured in from the West, and at the same time, a lot of consumer products, like automotive vehicles to mobile phones from China, are coming in. The government of Malaysia has perfectly balanced its diplomatic and economic ties, allowing it to benefit from both sides without facing the geopolitical pressures that other nations encounter. Secondly, one should also understand that even though Malaysia does not hold gold in its reserves, it holds other assets like US dollars or bonds. If we were to graph out the international reserves of Malaysia by component, we get to see that as of January 2025, they have over $116 billion, which is insanely big as compared to the market value of Malaysia's gold reserves, which, as we mentioned earlier, is just about $3.2 billion. And here, as you can see the reserves by component, there are foreign currency reserves, which are divided into two subcategories: securities and total currency, and deposits, which are held in various global currencies, such as the US dollar, euro, and Chinese yuan. Securities refer to government bonds, treasury bills, and other financial instruments that Malaysia's central bank, Bank Negara Malaysia, invests in to generate returns while maintaining liquidity. Total currency and deposits, on the other hand, consist of cash reserves held in major financial institutions, ensuring that Malaysia has readily available funds for trade and economic stability. The second largest is SDRs, which is special drawing rights. They are an international reserve asset created by the International Monetary Fund to supplement member countries' foreign exchange reserves. And thirdly, you can see the gold reserves, which sits at $3.2 billion. So as you can see, when you compare the foreign currencies of Malaysia to its gold, gold is indeed small. And this is a major reason for Malaysia's low volume of gold, as they are just sitting on foreign currencies or treasuries. But is that good or bad? Well, the thing with gold is that it is a non-yielding asset. Unlike if Malaysia were to buy a US Treasury bond, which pays about 4 to 5% in annual interest, gold does not generate any returns. This is one of the primary reasons why Bank Negara Malaysia has chosen to prioritize foreign currency reserves and government securities over gold. The only problem with holding currency and not diversifying into gold is that Malaysia may become too dependent on the stability of foreign currencies, particularly the US dollar. While US Treasury bonds provide reliable returns, their value is tied to global interest rates and the monetary policies of the United States. If the US Federal Reserve lowers interest rates, or if the dollar weakens, the returns from Malaysia's foreign currency reserves could decline, affecting the country's financial security. Finally, one last thing that we see as to why Malaysia has to hold foreign currencies, and not gold, can be because of Malaysia's high external debt. If we were to graph out Malaysia's foreign reserves related to the size of their external debt, we get to see that the figure is 1.0, which means that Malaysia's international reserves are just enough to cover its short-term external debt obligations. A ratio of 1.0 indicates that the country's reserves match its short-term debt. meaning Malaysia has sufficient liquidity to handle immediate external liabilities. However, this also means that there is little room for error. Any economic downturn, sudden capital outflows, or depreciation of the Malaysian ringgit could put financial pressure on the country. If they were to hold gold instead of foreign currency reserves, it could pose a significant liquidity challenge. Gold is a non-yielding asset and does not provide immediate liquidity in times of crisis. But anyway, do let us know what you think. Thanks for watching.